What is up everyone? I'm Rose and welcome back to my channel. In this video, I'm going to talk all about the magic formula, which is a super powerful investing strategy that has earned 20 to 30% returns over the last few decades. Just to give you an idea, a 30% average annual return, you can turn $10,000 into $1 million in just 18 years. The best part, you don't need to be a stock genius to do this. The magic formula is actually a really simple strategy that anyone can follow. And it was described in detail in this great little book right here, the little book that still beats the market, written by Joel Greenblatt. So if you're interested in making a 20 to 30% return on your money with the magic formula, then keep watching. Hey, and before we get started, have you subscribed to my channel yet? If not, what are you waiting for? My channel is all about stock investing for beginners, and you're gonna learn a ton about how to intelligently put your money to work. So make sure to subscribe and hit the notification bell for new videos like this every week. So let's dive straight in. First, I'll explain what the magic formula is and how it works. Then I'm gonna give you some background info on why it works. And finally, I'll walk you through how to implement it on your own. The magic formula is a stock investing strategy developed by superstar hedge fund manager Joel Greenblatt. His fund, Gotham Capital, has an annual track record of 40% returns, which is really hard to do. Basically, Joel Greenblatt is a fucking legend in the investment world. He explains everything you need to know about magic formula investing in his little book, the little book that still beats the market. And I'll summarize the key takeaways of the book for you in this video. I've also linked to the book below in the description so you can check it out for yourself. All right, the magic formula is a system that ranks all the publicly traded companies in the US in order of best investment to worst investment. Then, using this ranking, you buy the top 20 to 30 stocks. And there's actually no rocket science involved. This ranking system uses just two key metrics. So what are these two metrics? I'll tell you what they are, and then I'll explain each one in more detail. The first metric is return on capital, and the second metric is earnings yield. Return on capital is the percentage of a company's earnings relative to the capital spent to generate those earnings. For example, Company A is a store that sells widgets. It costs $1 million of capital to build the store and hire employees and do all the stuff to get into business. Let's say that this store generates annual net profits of $100,000. So Company A has a return on capital of 10%, or $100,000 divided by the capital of $1 million. On the other hand, Company B is a similar store that sells widgets as well. Let's say it also costs $1 million to get the store up and running. But unlike Company A, Company B generates $500,000 of annual profits. That's a return on capital of 50%. So which would you rather invest in, Company A or Company B? The answer is obviously Company B. The higher the return on capital, the better, because it means this business knows how to maximize profits given a fixed amount of resources. Sure, great companies have great products, good CEO, growth potential, all that good stuff, but all of those factors are very subjective and kind of qualitative. The only way to know for sure whether a company is a good investment or not is to look at the numbers. And the best number to look at is return on capital. By definition, great companies generate high returns on capital. So that's the first metric the magic formula uses to rank the best stocks. The second metric is earnings yield. Earnings yield compares a company's earnings to its purchase price. For example, going back to my widget examples, Company A that earns $100,000 a year, and let's say that the owner is willing to sell you the company for $5 million. Is it a good deal? Well, it depends. What is that $5 million gonna get you? If you buy Company A, you're gonna be entitled to its earnings of $100,000 a year. On a purchase price of $5 million, that's an earnings yield of 2%. On the other hand, let's say that you have the option to buy Company B, and it's going for the same price of $5 million. But as you know, Company B has earnings of $500,000. In other words, an earnings yield of 10%. So what's a better deal for you, Company A or Company B? The answer is, again, Company B. Even though they're both trading at the same price of $5 million, Company B is actually a better deal than Company A because you're going to get more earnings for the same purchase price. In other words, more bang for your buck. The higher the earnings yield, the better, and that is the second metric used by the magic formula to rank stocks. When you screen stocks through these two metrics, you end up with stocks of great companies at bargain prices. That is what investing is all about. It's common sense, right? You don't want to buy shitty companies, you want to buy great companies. And you want to buy those great companies, not just at any price, but at bargain prices. You want the best of both worlds. You want great companies, bargain prices. And so, the magic formula is a simple, systematic way to do just that. When you systematically buy stocks of above average companies at below average prices, you're bound to do really well. In his book, Greenblatt compares how a magic formula investing strategy performed relative to the S&P 500 over a 21-year period between 1988 and 2009. Hopefully he comes out with an updated edition with more recent numbers, but you can still get the idea. The magic formula investing strategy generated 23.8% over that period compared to the S&P 500's 9.5%. Whew! That means if you started with $10,000 in 1988 with the magic formula, you'd have $885,000 by 2009, compared to $67,000 if you just stuck with the S&P 500. Amazing, right? So what's the catch? There's always a catch. If it was that easy, everyone would be doing this and we'd all be bajillionaires. So like anything worth doing, the magic formula works, but it's a long-term investing strategy. If you're looking to get insta-rich, then you're probably not going to stick with this formula because it takes at least 3 to 5 years to work. Even though the magic formula outperforms the market over the long term, it might actually underperform the market for small stretches of time. Unfortunately, most people aren't patient or confident enough to keep the faith and stick with the strategy long enough to enjoy those amazing 23.8% returns. Don't be one of those people. If you're going to invest with the magic formula, plan to stick with it for at least 3 years, even if your friends are making more money in sexier stocks like Amazon and Tesla. The key here is patience. Now I want to touch on why the magic formula works. The average newbie investor has no idea how to evaluate stocks. Most investing beginners invest in the hot stocks that everybody's talking about, and they don't really know why it's a good investment other than the fact that other people are saying it's a good investment. If you buy individual stocks without crunching some numbers and forming a solid argument for why it's a good investment, then you're just gambling. You're investing based on hope, greed, FOMO. And all of these emotions have no place in your investing decisions. As Joel Greenblatt says in his book, choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. But you know what? Researching individual stocks is a lot of work. That's what Warren Buffett does. He reads a ton and he usually only has about 8 to 10 high conviction stocks in his portfolio. Most people aren't cut out for that. That's why most people are advised to diversify their investments as much as possible with something like an S&P 500 index fund. But the magic formula is something in between Warren Buffett and an S&P 500 index fund. The formula screens through thousands of stocks and you end up buying only the top 30 stocks. So it's still very diversified because 30 is still a high enough number that you're not overly exposed to one stock, but it's not as diversified as an S&P 500 fund, which has 500 stocks in it. So the magic formula gives you better results than an S&P 500 index fund because it has diversification, but it's also excluded most of the mediocre stocks. Personally, I think the magic formula is brilliant because it gives you the best of both worlds. It takes the emotion out of investing decisions because it's basically purely quantitative, just based on these two metrics. But it also doesn't require me to do a ton of research and value companies all day. Although I do also invest in individual stocks, I invest about 1/3 of my money using the magic formula because it's a great way to always have some money working for me in the stock market, even when I don't have any investment ideas of my own. Hopefully by now you're convinced that the magic formula is awesome and that you should totally try it. Now I want to walk you through how to implement it on your own. So here's how it works. First, you have to buy 30 magic formula stocks over a period of 1 year. And you spread it out over the year in order to spread out your entry points into the stock market. Then you hold each stock for 1 year and then you sell it. So the end result is that you'll always be rotating through 30 stocks in your portfolio and always selling each stock after a holding period of 1 year. So here's how to do it step by step. First, you need a brokerage account with money in it. This can be an IRA or a non-retirement brokerage account, whichever you prefer. Ideally, it's at a discount brokerage like Fidelity or Robinhood where you pay little to no trading commissions, because you'll be buying a lot of stocks and the commissions can really add up. Then step number 2 is to go to magicformulainvesting.com and create an account so you can use their stock screener. This website was developed by Joel Greenblatt specifically to help Magic Formula investors implement the strategy. So you use the stock screener to generate a list of the top ranked companies. In the screener, I'll just put $50 million as a minimum market cap. But if it makes you more comfortable to invest in larger companies, feel free to use $100 million or higher. After you click Get Stocks, you'll get a list of the companies that have the highest returns on capital, just like we talked about, and the highest earnings yields. So these companies have the best of both worlds and they're all ranked. Also, the Magic Formula is based on buying equal dollar amounts of each stock. So since the full portfolio has 30 stocks, if you have $30,000 total, then you'll want to buy $1,000 worth of each stock. After you buy your first 5 stocks, then wait 2 months and then buy 5 more. Keep doing this every 2 months, and 12 months later, you should have 30 stocks in your portfolio. So you bought stocks in batches of 5, and you did that 6 times over 12 months, if that makes sense. After 12 months, the first batch of 5 stocks that you bought has now been in your portfolio for 1 year. And remember, the Magic Formula wants you to hold each stock for just 1 year. So this is where it can get a little bit tricky. You have to keep track of when you bought each stock and make sure you sell it after exactly a holding period of 1 year. I keep a simple spreadsheet. It's not that hard. Yeah, it does involve a little bit of work, but it's definitely a lot less work than researching individual stocks. I don't know about you, but if it means I can make juicy returns of 20-30%, I'm game. Because I didn't want this video to turn into an hour-long tutorial, I know this is a pretty brief walkthrough of how to implement, but if you're serious about doing it, then definitely check out Joel Greenblatt's book for detailed instructions. Or if you want to see me do an in-depth tutorial with screencasts and my spreadsheets and all that, then type tutorial in the comments below to let me know. So that's basically what Joel Greenblatt's Magic Formula is all about. And by now, I hope you have an understanding of why it works so well and why it's a good idea for most people. As Joel Greenblatt explains, most people have no business investing in individual stocks on their own. So the Magic Formula is an easier, more accessible way to invest in the stock market. I think the key takeaway here is that picking great businesses at bargain prices is the absolutely fundamental concept of smart investing. So whether you implement the Magic Formula or not, you can still use these concepts to make better investing decisions. For example, rather than buying the 30 stocks on rotation the way the Magic Formula wants you to do, you can also maybe use it as a handy stock screener. So you can just use that ranking of 30 stocks as a starting point for stocks that you might want to do more research on. Did you like this video? If so, then please give it a thumbs up. And if you have any questions at all about the Magic Formula, feel free to ask me in the comments or DM me on Instagram at investingwithrose. To learn more about money and investing, make sure to check out these 2 videos right here. And if you're new to the channel, I'd really love it if you subscribed. Always remember to go after your dreams unapologetically and to live life on your terms. Until next time, bye.